Imagine this. You want your money to grow not just through risk-taking in the stock market, but with a structured, predictable plan. You want an investment that pays you regularly, protects your capital, and still allows you to dream big. That's exactly where bonds come in. In today's video, we'll explore the world of bonds. You'll learn what they are, the different types, how their returns are actually calculated, and, most importantly, the optimal strategy to manage a bond portfolio. By the end, you'll see how bonds can give you balance, stability, and clarity in your financial journey. So let's start with the basics. A bond is essentially a loan that you, the investor, give to a government, a company, or a city. In return, they promise to pay you interest every year. We call this the coupon. And at maturity, they give you back your money. But here's something many beginners overlook. The return from a bond is not just the coupon. It's made up of two parts. First, the difference between the price you pay when you buy the bond and the redemption value at maturity, usually 100. Second, the annual coupon payments you receive. This combination determines the real yield of your bond. Now let's connect this to interest rates. Central banks, like the Federal Reserve or the European Central Bank, often raise or cut rates. When rates go up, new bonds are issued with higher coupons. But your bond's coupon is fixed. That means your existing bond becomes less attractive and its market price goes down. If you sell before maturity, you could face a capital loss. However, there is an important detail that can play in your favor. As a bond approaches maturity, its price naturally moves closer to 100, the redemption value. This means short-term bonds tend to fluctuate less, while long-term bonds experience bigger swings in price. That's why professional investors often build strategies based on maturity profiles to balance stability with return. Now let's go deeper into the types of bonds you can choose from. Government bonds are considered the safest. They're issued by national governments and are used to finance public spending. For example, U.S. Treasuries are backed by the full faith of the U.S. government. Their yields are modest, but they are reliable. Corporate bonds are issued by companies. They usually pay higher yields than government bonds, but with added risk. Companies can fail, and their ability to pay depends on their financial health. Municipal bonds are issued by cities or local governments. They often come with tax advantages, which makes them efficient for certain investors. Imagine earning income while funding schools, hospitals, or infrastructure projects. That's the double benefit of municipal bonds. And finally, high-yield or junk bonds. These are bonds from issuers with weaker credit ratings. They pay high interest to attract investors but carry a significant risk of default. They're not for everyone, but for some they add excitement and higher potential returns to a portfolio. So how do you deal with the risks we've mentioned? Let's break them down. Interest rate risk. Prices fall when rates rise. Credit risk. The danger that the issuer cannot pay back. Or inflation risk. Even if you get steady coupons, inflation can eat away your purchasing power. The solution is strategy. One of the most effective approaches is diversification. Don't rely on just one type of bond. Mix governments, corporates, and different maturities. Another strategy is called laddering. This means buying bonds with different maturity dates, for example, 1 year, 3 years, 5 years, 10 years. As short-term bonds mature, you reinvest in new ones. This reduces the impact of rising interest rates and gives you a steady cash flow. And here's the golden rule. Align your bond investments with your personal goals. If you know you'll need money for a house in 5 years, buy a bond maturing in 5 years. This ensures certainty and protects your plans. Bonds are not about fast profits. They're about structure, discipline, and peace of mind. They provide stability when markets are stormy. They let you plan with clarity, rather than leaving your future to chance. Sure, They come with limitations. They won't deliver the explosive returns of stocks, but with sufficient capital, they can provide steady and predictable growth. But remember, every strong portfolio needs a solid foundation. Bonds are those foundations. They're the pillars that support your bigger financial ambitions. So evaluate your risk profile alongside your objectives and ask yourself, can you handle periods when your investments are driven by market speculation? Or do you want a reliable instrument to help you achieve your financial goals? Do you want to find out how to save more, invest better, and plan concrete goals? If you'd like to know more, subscribe to the channel and watch the next video.